Brad Williams, Frugal Finance, margin calls. What is a margin call? When markets move fast, they can knock even seasoned investors off balance. A margin call is one of those moments your brokerage tells you that your account has fallen below required threshold and it's time to add funds or sell assets. This typically happens when you borrowed money to invest and the value of your holding drops. In essence, a margin call is your broker's way of protecting their loan and your portfolio from spiraling losses. Understanding what triggers a margin call can help you avoid panic and stay in control. Margin accounts explain. To trade on margin, you need a special type of account, a margin account. It lets you borrow money from your broker to buy securities, with your own assets acting as collateral. This adds leverage to your investments, potentially boosting gains, but also magnifying losses. Margin accounts are also required for short selling and some advanced option strategies. Before trading on margin, it's crucial to know the risk rules and your broker's specific requirements. What can trigger a margin call? Three scenarios commonly trigger margin calls. First, if you make a trade that goes beyond your buying power. Second, if the value of your portfolio falls, reducing your equity below the maintenance level. And third, if your broker raises its margin requirements, sometimes it can do without warning. Each of these situations can tip the balance and prompt your broker to demand additional funds. Trading beyond buying power. Federal Reserve Regulation T allows brokers to loan up to 50% of an eligible securities purchase price, but if you attempt to buy more than you can cover, even with borrowed funds, you risk a margin call. For example, using $2,000 to attempt a $10,000 purchase may require you to cover a gap that the brokers won't automatically fund. If you can't provide that money within a few days, typically 3 or 4 business days, your broker may liquidate your assets to settle the score. Equity. A margin call can hit if your account equity drops below the maintenance requirement. This equity, your share of your account's value, must remain above a minimum level, often set at 25% by FINRA. However, many brokers demand even more, sometimes requiring 30 to 40% or higher. If your investments lose value and your equity dips below the floor, brace yourself for a call or worse, an automatic sell-off. Brokers change the rules. Even if you don't make any new trades, margin calls can still catch you off guard. How? Your broker might raise its house margin requirements due to market volatility, company bankruptcy, or other risk factors. That change can instantly tip your accounts below the threshold. Worse yet, brokers don't have to notify you before selling off your assets to cover the shortfalls. Staying informed about your broker's policies is essential. How to satisfy a margin call. If you get hit with a margin call, you'll need to act fast. You can deposit more cash, transfer margin eligible securities, or liquidate some of your holdings. For example, a $6,000 margin call at 60% coverage requirement, you need to deposit $10,000 worth of eligible stock. If selling, you might need to part with $15,000 in securities at a 40% maintenance margin. Do the math quickly. The clock starts ticking as soon as the call arrives. Know your margin agreement. Before you ever experience a margin call, take the time to read your margin agreement. This document outlines how your account operates, your collateral responsibility, and what your broker is allowed to do. Many investors skip the fine print, but in margin trading, those terms can mean the difference between staying afloat and forced liquidation. Your best defense is knowing exactly how your account works. Monitor regularly and use buffers. Successful margin traders keep an eye on their accounts daily, especially during volatile markets. Use alerts or portfolio monitoring tools to stay informed. Establish a buffer. Don't trade so close to the margin limit that even a minor dip triggers a call. If you're unsure how much cushion you need, ask a financial advisor to help model a few scenarios. A little preparation can go a long way when markets start to shift. Final thoughts: stay prepared. Margin calls can be a powerful tool, but it carries serious risk. Margin calls aren't just paperwork, they can lead to real financial losses. The key to navigating them is preparation, understanding the rules, monitor your investments, and react quickly when the unexpected happens. With discipline and diligence, you can use margin responsibly and avoid getting caught off guard when the market turns. I can't tell you how many margin calls I've had. Yep, a lot of them my mistakes. But if you don't understand margin calls, you're going to be shocked because the broker will sell your assets and you will take a serious loss. So read your margin requirements, If you've gone through this route, share your experiences. What caught you off guard? Were you just naive? Or are you prepared and you had additional securities you could use as collateral? Or you just have a bunch of liquid cash and you said no big deal. It was just market volatility. Anyway, let me know. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.